Happy Monday, happy Veterans Day. Welcome everybody, wherever you're chiming in from. If you're chiming in from YouTube, if you're here with me on the Zoom call, welcome. Good to see you tonight. Let's make sure we got everybody admitted to the Zoom call real quick. Let's go. Let's go. So guys, happy Veterans Day, man. You guys are real deal. You hopping on a call, like a live stream call for Veterans Day? You serious about your business, and that's who I want to be around, guys. Those of you who are serious about your business. All right, so let's go, guys. Let's get into it. Game don't stop. Ain't that the truth? Let's go, guys. Welcome. This is me, Cheston Bolgen with By the Books Consulting. We are the company that hosts this educational series that we do on live on Mondays. The Trucking CFO Tax Strategist, also known as your accounting superhero. You can reach us at 888-4BTB now. That's 888-428-2669. You can also reach us online at youraccountingsuperhero.com. All right. So I'm going to shout you guys out on YouTube. Welcome. Just typing in that chat real quick. And you can also reach me via email at cbolgen at youraccountingsuperhero.com, cbolgen at youraccountingsuperhero.com. And guys, you know the deal. We help out in the areas of accounting and tax and QuickBooks and technology to help you run your trucking company. The tax strategy is a big deal. Making sure you understand like what to do, come up with a game plan on what to do, and then more so than that, the execution of that. The action steps that you are committed to taking to ensure that that strategy is realized at the end of the year, at the end of the day, really. Okay. And if you haven't joined us yet, I invite you to join us at the truckprofitacademy.com. It's not going to be free up forever, but it's free now. And at December 31st is going to be the last day that this community is going to be offered for free. And we are dedicated to creating resources like this for you all the time. There is a mastermind that's coming down the pipe, and I'm sending out the survey to see exactly what it is that you guys want to have inside of the mastermind. And, I have a really good idea of what we're going to bring to the table with that. The concept is iron sharpens iron. You guys can help each other out, but I will be leading those calls to make sure we're talking about things that are relevant to you, getting to those next levels, no matter where you are in your business, getting to those next levels. And I just love being in that conversation, guys, because when I'm here and communicating these principles and the action steps it takes to go from where we are today to the destination that you would like to see tomorrow, I get elevated myself. I get a lot of benefit out of that myself because it reinforces the things that I get to do for my business. And, I have the actions every day that I can take for me, so that's why we're building this mastermind. It's iron sharpens iron. And, just make sure you fill out that survey. The emails are coming, guys. So make sure you're on the email list and that you take advantage of that to put your feedback in terms of what you want to see in the mastermind. In terms of the dates, like the days of the week that you want to meet, the times, and the content that you want to actually go over in those masterminds. And that's part of the Truck Profit Academy as well. And you can join that by going to www.truckprofitacademy.com. You can also take advantage of a free profit and cash flow analysis. The idea here is to stop wasting time and increase your cash flow and profits as soon as today. That's the intention behind this. So take advantage of it by going to youraccountingsuperhero.com/book-and-appointment. And a quick disclaimer before we get started, the following is for educational purposes only and is not to be considered financial, accounting, or legal advice. Please consult your tax, accounting, and/or legal professional for specific advice. So let's go, guys. We're in this conversation today. Really, this is an exciting time of the year because we're talking about how you can set yourself up to win when it comes to keeping your hard-earned money in your pocket, specifically when it comes to taxes. Okay, so most of the time you're going out day in and day out handling the operations of your trucking company. And it can be a monotonous, repetitive situation when you're doing that. It looks like, putting out fires. You got to make sure you're on, you're answering the phones, for check calls, emergencies like out there on the road with drivers. You never know what they're dealing with. They need to get access to fuel. They need to get access to T-checks, com checks. So breakdowns happen, like blowouts, tires, some equipment failures. And, these are the things that you would handle day in and day out. And specifically, of course, load planning and everything that you do to run your business is something that you get to do every single day. And the idea with the conversation that we're in is to take a moment to step outside of that. Take a moment to step outside of the day-to-day automaticity, the day-to-day automaticity, so that you can run your business at a higher level, right? So you can get to work on the business. What it really looks like, putting those structures in place so that you are achieving specific outcomes that set you up to win in trucking, which means you get to make more, keep more. You get to have a level of ease and freedom around running your business because now you are the CEO instead of just the owner operator of your business. And it becomes a really powerful position to be in when you take the time to understand these things, but also create the strategy and the plan of execution on the strategy. So that's the purpose of our conversations. As like this time of year, we've been talking about year-end tax strategies, and it's November 11th, guys. So 1 month is already down in the last quarter of the year. What are you actually doing right now for yourself to ensure that you're setting yourself up to win when it comes to these strategies that we've been discussing? All right. So when we have these conversations, guys, the intention is for you to take action. Make sure you're putting one foot in front of the other, taking advantage of the things that we talk about here today. And one of the things we're going to talk about today is investing at this time of year. What does that look like? To invest in buying new equipment, and maybe it's a tractor, maybe it's a new truck, maybe it's a new trailer, maybe it's another piece of equipment that helps you run your trucking company. And the opportunity is now to do that if the situation is you've been winning profitability-wise, you've been making good money throughout the year. So we've been working with the company. They've been doing pretty good, really well, a lot of profit, okay? Generating millions and millions of dollars in revenue, but they don't have a whole lot when it comes to the expenses. So they actually are generating, 7 figures in profit. Pretty decent, man, pretty good for somebody who's, this particular company's been in business for less than 5 years, okay? So, and they're in the trucking industry, okay? And the idea is, well, how are we going to make sure that he gets to keep the money in his pocket because of his success, right? You don't want to be, at the detriment of your success. What? You don't want to be at the detriment of your success, right? There are some things that, like when I say some things, I mean, there's some downsides to being successful, and it, right? It means that, okay, well, I made all this money. Am I going to be able to keep it now in terms of taxes? Okay, because sometimes when we make a good amount of money, we're like, man, yes, I made it. So we start spending this money on things to improve your lifestyle, to improve our lifestyle. Cash goes to certain things personally, which is okay. You can do that because you run your business. And the idea of running your business is to be successful running your business. And because you're successful running your business, you have more money. And when you have more money, you can purchase more things. You have more purchasing power. Yeah. And a lot of times we don't really account for the fact that there is a huge tax bill associated with being highly successful in your business. And we don't put that away. We don't plan for that. Okay. Now, planning for that comes in 2 different phases. One, it's setting the money aside so that come April 15th, you have the money to pay whatever you owe in taxes. You're ready for that. You know exactly what you're going to pay, and you have the money set aside. Okay. And if you've been planning pretty well there in that aspect, you've been paying your quarterly taxes so that that amount that you have to come out of pocket come tax time is not going to be as significant as what it could be. Okay. And that's one aspect of planning that you can put into place to make sure that you're good, you're above reproach. The other aspect of that, there's another approach to that is to make sure that if you know that you're being successful in the current year, have a strategy in place to ensure that money, you get to keep it. You don't have to pay any taxes. legally. Okay, you want to make sure you have the action steps in front of you so that you win legally when it comes to tax savings. So purchasing equipment is another one of those opportunities that we have to leverage the tax code, tax laws, so that you can still win when it comes to keeping your hard-earned money in your pocket. So let's talk about buying equipment. It's pretty cool, okay? Pretty cool concept here with the tax code. It allows you to, first of all, when we purchase things like equipment, it's considered like an investment into your business. It's not something that's considered an expense right away. For the most part, it's not considered that. So for example, if I go out and buy a new truck for $150,000, the law says that, well, you're not going to be able to expense that in the first year that you buy it. You need to expense this over time, which basically means it wants to be depreciated. So depreciation basically means that I'm expensing this purchase of this investment that I made in equipment or real estate or vehicles. I'm expensing that over time, somewhere between 3 and 27 and a half years, okay, or 39 and a half years, really, is that range that we can expense things over time. And wherever that type of asset falls determines the amount of time that you expense that asset, the period that you expense that asset over, okay? So bottom line, you're not going to be able to take that expense up front because it's a consideration that when you buy this, it's really just you transferring money from cash to the asset that you're using to run your business. So you still have the value. It just transferred from cash money value to equipment value, and you still have it and to be used. That's how it's looked at, okay? This is why when you go out and buy equipment, they say you can't really expense this equipment. You can't write it off entirely in the first year. It has to be expensed over the period lifetime of the equipment. That makes sense, okay? Because really the value of it went from cash and transferred over to equipment. So you still have it. It didn't go anywhere. You still have it. Whereas if I were to go out and buy fuel as an expense, that fuel gets used up. You don't have that fuel anymore. If you go out and buy tires, those tires get used up, right? In terms of wear and tear. They're not really used anymore, right? If you go out and buy office supplies, those are things that we're using up very quickly, right? And they're expensed out. And they're less than $2,500 usually when you're buying office supplies, okay? All right, now what I want to leave you with here in terms of my communication is a base understanding of the rules of the game so that you can understand, well, what's going to be your strategy to ensure that you can still benefit from this. Because the IRS has rules, the tax code has rules to incentivize you into buying equipment. And one of those rules is, accelerated depreciation. We have accelerated depreciation. What does that mean, Justin? What does accelerated depreciation mean? Now, when we talk about this, it just basically means that instead of going by the conventional rules that it has to be expensed over time, you can expense it up front. You can choose how you want to expense it. You can expense a lot of that in the first year. You can expense all of it in the first year if you wanted to, depending on the rule that you're using, the rule that you're applying for depreciation. So what I'm saying is that this strategy of buying equipment can work to your benefit if you understand the different rules that you can use to take that full expense up front. All right, so a couple of things that we're looking at when it comes to that. I just want to go over these two. Purchasing equipment and purchasing assets. You guys have heard this, okay? These two things. Now, first, before we go into the two things, there's an intention that you want to have in mind when it comes to this. The main intention is to take advantage of the depreciation expense to lower your taxable income. The intention is to take advantage of the depreciation expense to lower your taxable income, okay? Take advantage of the depreciation expense to lower your taxable income. Now, when you expense things, your income is lower. I've had conversations with people, man, and they didn't realize, I guess I'm taking it for granted that people would just know this. Just as a fundamental thought process, But some people don't understand that it's not the money that you bring in that you're taxed on, it's the money that's left over that you're taxed on in a business. Anybody not know that? Okay, just checking in. If you knew that, put a one in the chat, please, for me. If you're on Zoom or if you're on YouTube, if you knew that you're not taxed on the money that you bring in, but you're taxed on the money that you left over, please put a one in the chat. Just fantastic, fantastic. Now, some people did not realize that. They think that they're taxed on the total revenue that they bring in. Not the case. All right, so there's an intention here to reduce the amount of income that you have, which is the cool thing about running a business, guys. Robert Kiyosaki's school of thought. All right, use the business to run your life. Okay, use the business to run your life. Thank you guys for putting that one in the chat. So use the business to run your life. That's the benefit of being an entrepreneur, is that things that would not normally be deductible would become deductible if it's an ordinary and necessary expense in a business. So if I shift my behavior to owning a business and now have all these other expenses that I can deduct that I would not be able to deduct as somebody who did not have a business, they become available, which reduces my income now, and I get taxed on what's left over. Okay, which is pretty fantastic. Okay, and now the idea is to be able to use this 100% in your actions. So that is the intention, to lower your taxable income, which means I get taxed on what's left over at the end of the day. So one of the main ways that we can do this, that we're going to talk about now, is depreciation. When we purchase equipment, we take advantage of accelerated depreciation. So what does that mean? We have two things here that we're looking at, two codes that we're looking at, section 168 and 179. These are the two codes we're going to look at right now. Okay. I'm going to give you an understanding, a basic understanding of what these mean when it comes to maximizing the tax code. All right. Now, section 169 is the first one I actually want to go over. Okay. Anybody familiar with this? Again, put a 2 in the chat if you're familiar with section 179. Put a 2 in the chat if you're familiar with section 179, deductions. Okay. The 2 in the chat if you're familiar with section 179, deductions. Let's go. Okay. So not getting a whole lot of 2s in the chats. Okay. So that's good. That's good we're having this conversation. So basically, section 179 deduction deals with what we were just talking about this whole time. When we buy equipment, we buy assets, really fundamentally, we're not allowed to write that off. Everything that we put into it, like if I buy a piece of equipment for $100,000, then I'm not able to write that entire $100,000 off this year. I'm allowed to write off if it's a 5-year deduction period, straight line deduction, that's what we call it, that I can write that off over the 5 years of the life of the equipment, which means $20,000 I can write off this year. Okay. And that's putting it simple. Okay. There's some other things that go along with that depending on the nature of it. Like if we do a half-year deduction for depreciation, but we're not going to get into that. But to keep it simple, you can only write off 1/5 of that because it's depreciated over 5 years. It's like, what? I just spent $100,000. You mean I can't write it off? I can only write off 20,000 of that? Yeah, typically that's what the rule is. If we don't apply something like this, okay? If we didn't know this, now you get to apply this section 179 code here to your depreciation, which means that you can deduct the entire amount of certain property. And I believe in this year, what's it this year? Let's go take a look. In 2024, I believe I'm not going to say I believe, I think it's 1.2 million. Let me just take a look real quick, guys. Make sure I'm in line with that. Yeah, section 179 is 1.2. I know it's 1.2 million, basically, in 2024. Okay, 1,220,000 is the deduction that you can take. You can take up to that deduction for the equipment that you purchase. Okay, so for example, if I buy a $100,000 truck, it's well underneath that $1,220,000 mark. So I can write up the whole thing if I just switch to using this one thing here. for the tax code if I apply with Section 179 and elect to write off that equipment inside of this code. Pretty cool. You can do that now. Now, there are pros and cons to that, guys. Now, it makes sense when you're looking to reduce all of your profits in a year in which you were completely like crushing it and you had a lot of profits in this year. This particular gentleman we were working with this year, like I said, I mean, he's doing well, man. He has millions of dollars this year for the first time. He's like really crushing it, more than double the previous year's income. And as a consequence, there's a lot of profit that we want to account for. He calls me up last week and says, "Hey, look, what can we do?" I said, "Hey, man, purchase equipment." Okay, buy some equipment. So he goes out and to buy some equipment. He calls me the next day. He says, "Look, I'm at the place. What do I do?" I was like, "Should I go ahead and get it?" He's like, "Yeah." I was like, "Yes, go ahead and get it." Now, what that makes available is that deduction of income. All right, that reduces the taxable income to the point where any dollar reduction that you have in your income, percentage-wise, with your tax bracket, that's what you're going to expect for a tax write-off. Like your tax will be lower. Your tax bill will be that much lower, and it'll be lower by your tax bracket. So what do I mean? Let's say you have reduced it $100,000, right? And if I take that $100,000 example of equipment, let me just do this for you so you can see it. If I have the $100,000 of a deduction, so I deduct $100,000 from my income, and my tax bracket puts me at 37%. This is just federal taxes now. Tax bracket 37%. Well, that just saved me $37,000 in taxes, right? Because you went out and purchased that equipment, right? So did you want to pay an additional $37,000 in taxes? Most likely not. And that's a good amount of extra taxes that you would have had to pay if you're profitable in this way, okay? Now, just by doing that, shifting that and buying the equipment and applying the Section 179 to write the whole thing off, you could save $37,000 if you're in a 37% tax bracket. Now, if your tax bracket's lower, then it's lower of a tax savings, right? And if it's higher, then it's higher with tax savings. Okay. Now, between your state and federal, anyway, it'll be higher. Okay. Hopefully that makes sense, guys. Like what the power behind this is just understanding, like if you go out here at this time of year and purchase equipment, you can have this type of savings so that when it comes tax time, you won't have this bill. Like you could have $37,000 less of a bill in this scenario. Okay. Now you may say, "Man, I don't have $100,000 to buy equipment right now. I don't have that amount to pay. And, if I go out and finance it, I do have like those obligations to make the payments on the trucks, on the equipment that I buy, which is 100% true, which is why you want to consult with somebody to see if it makes sense for you to actually go out here and do this. All right. Do the dollars make sense? Now, one of the main things that you want to look into to see if it makes sense is your current cash flow. Now, if you're crushing it, like in this example, where the guy's going out here and he's just making a whole lot of profit. So he does have like the cash flow looks really good too. It totally makes sense to do that because number one, he can do it in a way where he can finance the equipment. He doesn't have to come out of pocket and he can still get that $37,000 saved in taxes. Now, if he's doing it in a way where he's financing the equipment, the equipment could be somewhere around between $1,500 and $2,500 a month in equipment, right? Now, get this, that equipment, if he buys it, he's expanding his business, he's growing the business, he's getting more jobs done, so he's scaling it up, so that equipment's making him money, and he's saving in taxes at the same time. Get that, okay? So now it does make sense in his scenario. Now, if a situation where you're not going to generate, you don't have a way to generate the extra revenue, like you don't see it, you don't have the capacity, you don't have the extra lanes or the availability from clients, you haven't taken those actions yet, well, it may not make sense. And we might want to go a different route when it comes to saving you in taxes. All right. So now the other thing is we want to talk about before we hop off the call All right. And guys, just let me know, like, if that makes sense, man, just let me know. Give me the feedback. I know you guys are chiming in from all these different areas from online, specifically YouTube and um and in Zoom. So we want to get your feedback. Like, this makes sense, man. Put a 3 in the chat if it makes sense to you, right? Now, this is something that you can take on. Thank you for that. This is something that you can take on specifically to ensure this time of year that you are reducing that tax bill significantly when you're profitable. Okay. Now, the other one that we said over here is Section 168, which is pretty cool. Now, Tax Cuts and Jobs Act, you know, when Trump was in office the first time around, he put this into effect, which pretty much gave each person the right to write off up to 80% of whatever equipment or assets that were purchased in the first year with Tax Cuts and Jobs Act, and it phases out in 2027. Right now in 2024, what that looks like is that you're able to write off 60% of whatever you place in service this year for assets. So when I say placed in service, all that means is that you buy equipment this year for business use this year. All right, so that's what that means. You buy equipment this year that you're going to use this year, and when you do that with the Section 168, it allows you to write off this year, 2024, 60% of the what you purchased. So in this example, same example that we had before, the $100,000, you won't write up the whole $100,000. You'll be able to write off 60,000 of that in the first year, and then the rest of it gets depreciated over the rest of the life of the equipment. Okay. Now, pretty cool, pretty fantastic code to use. Not as great as the Section 179, if you're paying attention. Okay, not as great as that, but it is a tool that we can use to make sure that you're taking advantage of the tax code rather than just depreciating things over like that 5-year extent. You can take a lot more of that expense now if you're doing well this year. Now, there's a flip side to that. When you buy equipment and you take all of that expense up front in this year, well, you don't have that expense to take next year for the same piece of equipment. You don't, right? You don't have it to take the year after. And then also when you sell it, there's the gain that you get from the sale of that asset, and you have like a base of 0. So basically what that means is that any sale that you have for that, it will take you from the profitability, the profit that you have for that sale will be 100% profits on that. So for this example, if you depreciate the 100,000 all the way down to 0, and then you sell that off next year for $20,000, well, that $20,000 is considered capital gains of what you made fully. The recapture, and plus it's all recaptured, which is a different story altogether. There's a recapture rate for the depreciation. So the tax consequences for selling and getting rid of the asset and making money from that asset when you sell, if you fully depreciate it, it's something that you want to consider. Okay. So guys, it's so cool to have all of this understanding to strategize inside of your trucking company, because when you have this insight for you running your business, it gives you an edge to understand, number one, how to keep your hard-earned money, but then number two, it gives you the ability to start thinking newly when it comes to running your business. Now you start putting on your CEO hat and your CFO hat to say, okay, what makes sense here for me in the next year or so? When I go into 2025, what are we actually going to do here to ensure that we're going to win when it comes to taxes, we're going to win when it comes to profitability, we're going to win when it comes to cash flow. Like this produces a way of thinking that allows you to make sound decisions for your business consistently and reliably when you have this information in front of you. All right, so we definitely want to keep it clear when we're working on one thing in terms of taxes, but we can take this whole concept and apply it to other areas of your business as well, is what I'm saying. Like, it's the same basic fundamental thought process. How can I win here? What are the things that I have at my fingertips? These are the tools, man, that we got from the IRS. We have these from the IRS, Section 168, Section 179. How am I going to use these tools to help me win in business? We have other tools that are pretty cool when it comes to taxes as well, like tax credits. What tax credits are available? R&D tax credits. How can I use that? You know, how can I use the WOTC? You know, how can I use that to benefit? You know, you know, how can I use, you know, intangible drilling costs if I'm out in the oil market in order to benefit tax-wise and make sure that I'm taking full advantage of the tax code, right? That's what I want to leave you with there, okay? Now, the last thing that I want to talk about before we wrap up this call is when you're doing well, specifically this time of year, like late November, all of December, and you take on new contracts, you're making money, and you want to ensure that you get to keep a lot of your hard-earned money. Well, there's a cool strategy called deferring income, okay? We can defer income. Let's talk about that. What does that mean? Okay. And one of the things we're working on with another client is they took on a new contract, seven-figure contract for the last month or two of the year. And you know, they've already been doing pretty well this year when it came to revenue. So why not withhold on invoicing these clients until next year? All right, they can do that, right? So legally, they can defer the income. They don't have to bill out their invoices this year. They can wait till next year to bill those out. Come January 1st, they bill them out in 2025, and that income doesn't apply to 2024. All right. So why would you want to do that? Well, you want to do that because if we take that income in now, it boosts up the revenue now. And if we're already doing well now, it's going to increase our tax liability now. Okay. Now I want to make sure that that gets shifted to the next year because there's a lot of room that we can use in 2025 to make sure that we still win tax-wise for that year. Right. And there's less room here in 2024 to ensure that we win when it comes to taxes this year. Okay. So now we can just push that to the next year. And all of a sudden, we reduce our taxable income in 2024. Pretty cool strategy to use there. All right. Now, what I want for you guys, what I want for us in this conversation is to understand, number one, strategy. Am I a strategic thinker when it comes to taxes? Am I a strategic thinker when it comes to taxes? How can I leverage some of these tools, these rules in the tax code to benefit from in my trucking company? Okay, that's number one, strategize. Number two, execution. Now, once I understand the strategy, how am I going to execute on this? Like put a date out here. I put it out in reality and say, okay, this is the date that I want to go out here and purchase my equipment. Oh, okay, this is how I'm going to set up my deferred income structure for this year so that when the money comes in, I'm pushing it out to 2025. Okay, you want to understand that. You want to get with your professional. You want to get with your tax professional. Consult with them, consult with your financial person to make sure you're making these decisions the right way so that you can set yourself up to win big in trucking when it comes to taxes. Okay. I'm hoping that you got some value from this call today, guys. It's been great being with you. Thank you for the feedback in the call. I got it, guys. Thank you for being with me here. It's always a pleasure with being with you on these calls. And go out here and be prosperous, guys. Take this information, run with it, strategize with your people. Make sure you have that plan of execution going so that you can set yourself up to win when it comes to taxes so you can keep your hard-earned money in your pocket. Guys, have a great week. Have a great rest of your Veterans Day, and I'll talk to you next week. Take care. Bye-bye.